I'd like to welcome you to another KhaliTutors tutorial session. In this tutorial session, our main focus will be on the double entry principle. If you're new to accounting, this video is going to be very helpful, so please stick around. If you're new to our YouTube channel, please subscribe to get access to the latest public videos the moment that we upload them. If you'd like to access private content, please click on the join button to become a member. Without wasting your time, let us look at the lesson plan for this tutorial session. So this is what is going to be discussed in this lesson. We'll first look at the general ledger. We'll go through the definition of the general ledger and then explain the different concepts that are important for you to understand what the general ledger is, okay? We believe that you cannot really understand what the double entry principle is without really understanding what the general ledger is, okay? So the general ledger is important for you to understand the double entry principle. So once we have defined what the double entry principle is, we are going to give you so many examples and we are going to take you step by step in such a way that I am 100% sure that by the end of this lesson, you'll know exactly what a double entry principle is and how to use it in accounting. If you can master the double entry principle, I can assure you, you'll find accounting very enjoyable. The last part of this lesson, we will discuss what accounts are versus what journals are, okay? I think it is important that you know how to distinguish between accounts and journals. Without wasting your time, let us define what the general ledger is and explain it, okay? In my experience, I have always seen a huge difference in terms of students' understanding of accounting whenever we start by teaching them what a general ledger is. Okay, so let me give you the definition and then I'll use an example to try to simplify this definition. Okay, so the definition goes like this. The general ledger is the collection of all assets, equity, liabilities, income, and expenses accounts. Okay, so what we need to take from this definition is one, it is a collection of accounts. And then they told us that these accounts are classified as assets, equity, liabilities, income, and expenses. Okay. So let's try to think of an account as a folder that has a file where we record the increases or decreases of particular elements, for example, of particular assets. Okay, let's use an example to illustrate this. Okay, let's say I have a company. The company's name is, let's say it's KhaliTutors, okay? I have several companies and then I have a folder for KhaliTutors. Inside the folder for KhaliTutors, I will have my journals and then I will also have a general ledger, okay? So this is what we define. According to the definition, a general ledger must be a collection of all assets, equity, liabilities, income, and expenses accounts. Okay, so if it is a collection, if you double click on this general ledger folder, I will need to have these elements. Inside, you see you have your assets, equity, expense, income, and liabilities. But inside your assets folder, you have the different assets, okay? Let's say the company has land and buildings, then you will have a folder for land and buildings. Inside this folder, this is an account, remember. Inside this folder, we record the increases and decreases of land. Let's say we purchase land, then we are going to record that information in the file inside this folder, okay? So let's say we have inventory, we decide to stock, then we are going to record the increase inside this folder, okay? we'll find a file inside the folder where we are going to record that increase. We are going to do the same for whether it's assets, okay, if there is increases in terms of equity. For example, the owner of a particular business decides to deposit money, then we have an increase in capital contribution. We are going to record that inside this folder. Okay, so this file here will represent something called a T account, okay? So basically what a T account looks like, as we know that at the moment we are inside the capital account. So you'll have something like this. This is where you're going to record your increases and decreases. Okay, if there is an increase in the capital amount or capital contribution, we are going to write the information on the right hand side of this account. Okay, so here you'll write the date when that particular increase took place, then you'll write details, okay, and then you will write the amount here. Okay, I'm going to explain further this information here as we proceed, but at the moment, in order for you to understand what we mean by general ledger, I think this is just sufficient. Okay, so we are going to work on this file as we continue with the double entry principle. But at the moment, what I want you to know is that the general ledger is a collection of assets, equity, expense, income, and liabilities accounts. That is all that you need to know. Okay, now that you understand what a general ledger is, maybe it is the right time for you to know exactly what assets, equity, expenses, income, and liabilities are. Okay, so let us get back to our slides. Okay, so whenever we refer to assets, we are referring to the resources owned or controlled by a business that will bring future economic benefit. For example, if we have inventory, we can sell that inventory and then we get money. Okay, and when we are referring to liabilities, these are the business's obligations. This is equals to the amounts it owes to outsiders. For example, creditors, suppliers, and banks. Okay, and when we refer to equity, we are referring to the owner's interest in the business after deducting liabilities from assets. And when we refer to income, this is the money a business brings in from its main activities. And when we refer to expenses, these are the costs of operating the business. Okay, now that we are done with this, we need to move on to the main objective of this lesson. The main objective of this lesson was not to teach you the general ledger, but you needed to have an understanding of what the general ledger is in order for you to actually understand what the double entry principle is. Okay, so let us look at the definition of the double entry principle. Okay, at the core of accounting, what we are doing is actually keeping a record of all transactions. But basically, what are transactions? Okay, transactions are activities that include or involve the transfer of monetary value. That's all a transaction is. Okay, but don't stress too much about the terminologies and stuff like that. Examples are going to make everything simple. Okay, so let us take a step back. If we are going to record transactions, the question is, how do we record transactions in terms of accounting? We record transaction by following something known as the double entry principle. The double entry principle, in terms of its definition, means that every transaction affects at least two accounts in such a way that the accounting equation remains in balance. The accounting equation is assets equal equity plus liabilities. Okay, so from this definition, the most important thing to note here is that we are referring to a transaction and we say it affects at least two accounts. Minimum is two accounts. Okay, remember, accounts can be viewed as folders. Okay, think of accounts as folders for a particular item. It could be a folder that keeps information about the increases and decreases of an asset or a liability or equity or income or even expenses, but it is basically a folder. So if we say it affects at least two folders, what do we mean? Okay, I'll explain that by means of example. Okay, and then they say the accounting equation must always be balanced. In order for this to be balanced, the sum of all debits must be equals to the sum of all credits. Okay, don't worry too much about the term debit and credit. What you need to know right now is that every transaction will affect at least two accounts. Okay, I'll explain debits and credits as we proceed. Okay, so let us go back to our accounts. Remember, that's what will be affected. So we need to go back to our accounts. There is something important that I think we need to discuss. Okay, I'm not going to write this down. Okay, so now that we have these elements here, in total, these five are known as the elements of financial statements. In other words, the information in this is what is going to be used to create or compile our financial statements. Okay, so we have assets, equity, expense, income, and liabilities account. Okay, here is something interesting. You just need to memorize this. You don't have to understand why. Okay, when we record an increase in assets accounts, we record that information on the debit side of the account. And when we record a decrease in assets, we record that information on the credit side of that account. Okay, then we move on to equity. Whenever we record an increase in equity, we record this on the credit side of the account, the equity account. Whenever we record a decrease in equity, we record that information on the debit side of that equity account. This is not complicated. Through practice, you will know this by head. It's only 5 things that you need to remember, guys. Remember, in terms of expenses, whenever we make an expense, in other words, we are increasing our expenses, then we record that information on the debit side of the account. Whenever our expenses decrease, we record that on the credit side of the expense account. In terms of income, whenever our income increases, we record that information on the credit side of our account, and whenever income decreases, we record that on the debit side of our income account. In terms of liabilities, whenever we record an increase in liabilities, we record that on the credit side of our liabilities account, and whenever we record a decrease in liabilities, we record that on the debit side of our account. Okay, I did not write this on the screen so that you practice it, okay? But don't worry. As we do examples, you will see what I mean. Okay, now I've been talking about the credit side, the debit side. But what do this credit side and debit side looks like in terms of our accounts? Okay, so for example, let's click on our assets. Okay, so in terms of our assets accounts, we have these ones here. I've just created folders for a few. You can refer to this chart okay, to see some additional assets accounts and liabilities account, equity, income, and so on. Okay, I'm just using the folders that I've created to actually teach you how to go about applying the double entry principle. Okay, so let's go back. Remember, we are inside the assets folder. Okay, so inside this folder, for example, let's click on our inventory account. Remember, inside the inventory account, we are only going to record the increases and decreases in inventory. So the only thing that we record in an inventory account is the activities of inventory. Okay, we are focusing on one item and one item alone. Then if we purchase inventory, that means our inventory is increasing. Since this is an asset account, we are going to record that information in the debit side of the inventory account. Let's look at the file inside the inventory account. So inside the inventory account, you have this file here. I've been talking about the debit and credit side of the inventory account. So this is what your inventory account file looks like. Okay, you have two sides. These sides are separated by this line here. Starting from the date to the amount, this is our left hand side. Starting from date to the amount, this is our right hand side. Here you're going to write the date if, for example, inventory is increasing and we are focusing on this right hand side. You're going to write the date on which the transaction actually took place. And then here you're going to write the name of the account that is going to be credited. Since here we are debiting this, okay, then there must be another account that is credited. Remember, it's a double entry principle. So it means for every transactions, there are two accounts that are affected. So this is where you are going to tell us which other account is affected by this transaction. Okay, let me give you an example to illustrate this. Okay, let's go to this one. Okay, I'm gonna look at this one. Here is a simple transaction. They tell us that on 1 February 20.1, we are using 0.1 because we don't want to specify the year. Tom decided to start a carpet cleaning business called Fix and Mat. He made a direct EFT of 130,000 from his personal savings account to the bank account of Fix and Mat. Okay, so from this transaction, the first thing that you need to identify is actually the accounts that are involved. The first account that is involved is what? His capital contribution. So this tells us that the capital account needs to be involved. Remember, the capital account is an equity account. So whenever we record an increase in equity, we record the information on the credit side. Remember that, but this you need to practice, okay, on the credit side, okay? So that's the first account. And the second account that is involved is the bank account. This money came as a capital contribution from his personal savings to the bank account. Okay, so that's what we are going to focus on. Let me go back to my files. Remember, our folders represents our accounts. So we need to search for the bank account, okay? In the bank account of the entity, remember the money came from the bank account of the owner. The owner is taken as someone from outside, but they were not buying anything. They were just contributing to the business, okay? So in that case, the money came from the bank account of the owner, and that is referred to as capital contribution. But it goes to where? It goes to our bank account. and our bank account is an asset account. So since this is an asset account, what you're going to do, you're going to record the amount here. In this case, that is 130,000. Okay. And then you need to tell us which other account is going to be, since this one is debited, which other account is going to be credited. Remember, double entry. So you write here, the capital account is involved. Okay, I'm just gonna do this, it will fix itself. Okay, capital. So this here in your details, you write the name of the account that is going to be credited, because this one here is debited. Then you write the date on which this took place. In this case, they told us that it was 1 February. Then you can write 1 here, and then here you can write Feb 20.1. Okay, then you're done in terms of the bank account. Now you need to go, remember it's a double entry. So the first entry is this one. Then we need to find the second one, and the second one, it's easy to know which one because you've already specified the information here. So the second one is the capital one. Remember, as you can see, on one transaction, it is actually debited, and on the other transaction, it is going to be credited. The capital account is an equity account, so whenever we record an increase, we are going to credit that account. So you go back to your account. We know that it is actually equity account. You go to your equity account. We are searching for capital, and in the capital account, okay, so this is the capital account, I think. Is it? Let's see. File. Okay, file, capital account. Okay, you need to record on the right hand side. You start with the date. This is Feb 20.1, and then this was on the 1st, and here you tell us which account was debited on this transaction, because we know that the capital account was actually credited. We know that it's the bank. Okay, so we are going to write the name of the bank that was debited and the amount. Okay, the amount that we are crediting the capital account. Okay, once you're done like this, you are done recording this transaction. Okay, so that's the whole point of the double entry system. For every transaction, there are at least 2 accounts that are involved. Okay, so I think for the first part of this video, this is sorted. The next parts will be available to members only. We are going to focus only on examples. Okay, I'm just going to demonstrate to you how to use the different sets of accounts to actually record transactions. Okay, so that's all for now. Okay, if you are a member, please access the other videos. Okay.